Welcome to my channel Trusted Investor Solutions. Today we are going to know about myths and facts about mutual funds. Myth 1: Mutual funds are for experts. In fact, mutual funds are meant for common investors who lack the knowledge or skill set to invest in securities market. Mutual funds are professionally managed by expert fund managers after extensive research for the benefit of investors. A mutual fund is an inexpensive way for investors to get a full-time professional fund manager to manage their money. 2. Mutual fund investments are only for long term. The fact is, mutual funds not only for long term but also for short term based on one's investment horizon and objective. There are different types of mutual fund schemes with short term and long term. In fact, there are various short term schemes where you can invest for a few days to few weeks to a few years. Liquid funds are low duration funds with portfolio maturity of less than 91 days, while ultra short term bond funds are low duration funds with maturity of less than a year. There are short term bond funds which are medium duration funds where the portfolio maturity ranges from 1 year to 3 years. There are long term income funds which are medium to long duration funds with maturity of 3 to 10 years, while equity schemes are most suitable for long term and debt mutual funds are suitable for investors with short term. Myth 3: Investing in mutual fund is same as investing in stock market. The fact is, mutual fund investment not only in stock market but also in bond market like corporate bonds as well as government bonds and in money market instruments such as treasury bills, commercial papers, certificate of deposit, collateral borrowing and leading obligation. And many of these instruments are not available to retail investors due to large ticket size of minimum order quantity such as government securities, and hence retail investors could participate in such investments through mutual fund schemes. Myth 4: Mutual fund scheme with a NAV 10 rupee per unit better than mutual fund scheme whose NAV is 25 rupees per unit. Or mutual fund scheme with lower NAV is better, or investing in NFOs are preferable than investing in existing schemes. In fact this is a common misconception. Mutual fund NAV represents the market value of all its underlying investments. NAV of a fund is irrelevant because it represents the market value of the fund's investments and not the market price. Any capital appreciation will depend on the price movement of its underlying securities. Let us understand this through one example. Here, two schemes are there, Scheme A and Scheme B. Scheme A NAV is 20 rupees and Scheme B NAV is 100 rupees. Suppose your investment is 10,000 in both the schemes, then in Scheme A you will get 500 units and in Scheme B you will get 100 units. Assuming that both schemes have invested their entire corpus in exactly same stocks and in the same proportions, if the underlying stocks collectively appreciate by 10%, then NAV of the two schemes should also rise by 10%. That is, 20 rupees NAV becomes 22 rupees and 100 rupees NAV becomes 110 rupees. Thus, in both the scenarios, the value of your investment increases to 11,000 rupees. Then we say that current NAV of a fund does not have any impact on the returns. Myth 5: One needs a large amount of money to invest in mutual funds. Fact is absolutely incorrect. One could start investing mutual funds with just 5000 rupees for lump sum. Only equity linked savings schemes, ELSS schemes, the minimum amount required is 500 rupees. In fact, one could invest via systematic investment plan with as little as 100 rupees per month for as long as one wishes to. Myth 6. One needs to have a demat account to invest in mutual funds. Fact. Holding mutual fund units in demat mode is absolutely optional except in respect of exchange traded funds. For all other schemes, including close ended funds like fixed maturity plans, it is entirely up to the investor whether to hold the units in demat mode or conventional physical mode. Myth 7. A scheme with a higher NAV has reached its peak. This is a very common misconception because of the general association of mutual funds with shares. One needs to keep in mind that the NAV of a scheme is nothing but a reflection of the market value of the underlying shares held by the fund on any day. Mutual fund invest in shares which may be bought or sold by the fund manager depending on the scheme's investment strategy. If the fund manager feels that a particular stock has peaked, he can choose to sell it. A high NAV does not mean the fund is expensive. In fact, high NAV indicates a good performance of the scheme over the years. Myth 8. Buying a top rated mutual fund scheme ensures better returns. Fact. Mutual fund ratings are dynamic and based on performance of the scheme over the time it is subjected to market fluctuations. So mutual fund scheme may be on the top of the rating chart currently but may not necessarily maintain the same rating month after month or later date. However, a top rated fund is a first choice to select a scheme to invest in particular scheme. Investment in a mutual fund scheme needs to be tracked with respect to the scheme's benchmark to evaluate its performance periodically to decide whether to stay invested or to exit. After knowing all these myths and facts, you are well aware of the mutual fund schemes. Still, if you have doubt, please comment on this section. Thank you for watching. Please like, share, subscribe our channel.